All right, traders, we are about to start the very next component of building a winning trading system. This is going to be part 4 of our series here that we are doing. If you have not seen the previous videos, we've done a couple already. Again, the top 3 there, the entries and exits, the extensive backtesting and forward testing videos. If you have not already seen those, then we are going to be building off of the concepts that we've already talked about. So today we're going to be talking about stress testing. Now, if you don't know what this is, I'm really excited to talk about it because it is a very, very important, actually possibly one of the most important things to look for when building a successful trading system. Obviously, we all want to be building systems that can stand the test of time, and this is really where stress testing is going to come in handy. Stress testing is basically finding the worst examples that your account could have gone through if you were trading a particular strategy. Let's say that we were using a Bollinger Band strategy and we had a particular market environment where the market just trended really hard and we were trying to sell at the highs or buy at the lows. Well, how bad did it really get? It's very important for us as traders to be completely objective in our analysis of building a strategy and to know what the worst drawdowns would have been like, so we know what to expect when we actually go forward with trying to build a strategy ourselves. So when it comes to stress testing, every strategy is going to go through some sort of tough time or drawdown or even a losing streak, right? Whether you're using a stop loss on your trades or you're not using a stop loss on your trades, drawdowns and tough times will definitely happen to every trader and on every strategy. So it's important for us to accept that and know that that is okay, but we need to know how bad is bad and what can we kind of expect reasonably if things were to not go our way, right? It's very important that we keep an open mind here and we face the facts, if you will. Trend trading strategies are going to suffer during range-bound markets, and reversal strategies during trending markets are going to have a hard time as well, as we mentioned with our Bollinger Band example. So how will your strategy fare in the worst scenarios when things are going really, really bad and it's just a market environment that is not helping you out whatsoever? How bad did it get? And most importantly, with this stress testing, did your strategy survive? We want to make sure that our strategy is actually capable of surviving through the tough times and the good. So to test this, I like to find the account blowing culprit. So a lot of times you'll see people talking about how their strategy has a great risk to reward, and historically, you know, they've made 100% per month and it's been great, but have they really experienced an account blowing culprit is like what I want to call it, right? Because basically what we're talking about is an example on the charts, a time where your strategy would have dealt with some really, really tough drawdowns, because a strategy can look really, really good in your testing until it doesn't, right? And you want to be aware of these. So finding the toughest examples out there, you can find on the charts, you plan on trading the system and see how the strategy performs. So basically we're going to go look at the charts that we're actually going to trade. If you have a gold trading strategy, we're going to go look on the gold chart, right? And we're going to go see what was the worst experience that this trading strategy would have gone through and objectively test it. So when we talked about earlier in this series, we talked about a Euro USD extreme trend to the downside that we saw and how that may have been a really, really tough example for our strategy to handle. So we need to look at these and see how bad did it get. So here's just a visual representation of an example of a really tough drawdown that a trend or breakout trading strategy may have gone through. Now you'll see that this is basically an example of a stress test, because let's say that you, for whatever reason, whatever your rules were, you took all of the trades here on this screen. Which, if you don't believe me, it's very possible to take 5 losses in a row. Ask anybody who's been trading long enough, and if your risk to reward is decently sized, if you have something like a 2 or 3 to 1, 5 losses in a row can actually happen, and more than once, right? So in this example, you can see we took 5 losses in a row. For whatever reason, let's just say that we took each one of these trades due to our rules that we've decided, and you know, it ended up in 5 losses. I know what people are going to say though. How could you ever take 5 losses in a row? Whatever you're doing must be horrible if this is going to happen. But I'm telling you that almost all strategies go through something like this at one point or another. It doesn't matter what your rules are. There are times where the market just does not want to help you out, and it does the exact opposite of what you're hoping for it to do. And so this is a very possible scenario, and we want to be aware of it. So let's say we had a theoretical breakout strategy here on the screen and we took all these trades. Well, how bad is our drawdown going to get? What was the worst that things got on our account, so that in the future we can kind of expect that that's probably going to happen if we trade this strategy long enough. It's the inevitable effect, right? If it's happened in the past, it's likely going to happen in the future again, right? And so we can kind of expect this and be mentally prepared for this to happen, and still know that it's kind of in the normal realm of possibilities for our strategy. So again, it's very important that when we get to this point, a lot of people kind of brush past this stress testing concept, and they kind of say, you know, things like, oh, I wouldn't have actually taken those trades because ... you know, Brexit was going on, or there was a trade war, and they speak in hindsight, and they kind of say, oh, well, that doesn't really matter to test. It'll be fine, right? And to me, this is where being picky and being diligent really, really matters. We need to be honest with ourselves and don't cherry pick in your stress testing. This is very important to actually really dig deep and not look past things. Take things honestly. If it fits your trading plan, then you should count them. And what I mean by this is, you know, let's go back to this example here on the screen. Again, some people might say, oh, well, I wouldn't have been trading this. It's too much of a choppy market environment. But you have to remember, when you're actually trading the price as it goes along the screen, you don't know if it's a choppy environment 100% until after the fact. So treat every theoretical trade here as if you did not have hindsight bias. And some ways to do that are to not look at future data when you're testing, or when you're stress testing, for example, right? You would hide part of the price action on the right side of the screen so that you don't have bias in your testing. It's very, very important that we don't pick only the best examples to look at in our testing. We actually, in this case, again, going back to the concept of stress testing, we're looking for the worst examples so that we can be prepared for them mentally, okay?